Okay, good afternoon and welcome back everyone to our Options Education webinar series. My name is Tony Zhang. I'm the Chief Strategist here at Options Play. I know we've been away for a few weeks. I hope everyone had a great Thanksgiving. I'm looking forward to the holidays coming up. But we do have a few more weeks of webinars before we break again for Christmas. And I have a pretty interesting schedule this December for everyone. First, I wanted to start off this month talking about risk and money management of trading. And I wanted to bring it up because last year during this time, we had a pretty tough sell-off going into the end of the year. And that was painful for a lot of people, including us, because of the fact that the markets moved so quickly, so violently, against some of the fundamentals that we were looking at, especially going into the very thin markets into the holidays. So I wanted to reiterate the importance of risk and money management in your trading so that if we get any type of sell-off at any point throughout this December, that you are perhaps better positioned for it than last year. And then next week, I actually have a very special guest. I have Tom Sosnoff from Tastyworks on, which him and I will discuss where we think the current markets are, a little bit about the market outlook, and also give you guys the opportunity to ask some questions around that. So very special December coming up. And then the last week before we break for Christmas, I have another special guest coming on from tradingcoach.com, one of the strategists here. He's been a mentor in the option space for almost 20 years now. I'm going to bring him on to bring a little different perspective on some of the topics that I usually talk about. Very special December coming up and looking forward to that. So let's go ahead and get started here. For those of you that are brand new to Options Play, welcome. You can sign up for a free 30-day trial to the tools that I'm going to show you here today. Membership just runs $75 a month or $500 a year towards once you finish the 30-day trial. And included with this is a free 12-step options trading course, as well as daily options trading ideas. And you can sign up using the link I just posted to everyone here in the chat window. So before we get started, just can everyone please bring up your chat window at the bottom of your screen, and please type yes if you can hear me loud and clear. I just want to make sure everyone can hear me before I proceed. Okay, great. Got a lot of yeses. Perfect. So again, like we said earlier today, the goal of this webinar is more of a refresher. It's something that I've covered before, but I want to really reiterate how important it is to manage your risk and money when you're trading options, because things can get ugly if things really sell off like we saw last year in December. And I just want to make sure that everyone is prepared. Everyone knows how to handle if we have another sell-off. Number one, what can you do prior to a sell-off so that you are prepared for it? Those are the things we want to go over here today. Now, a few things. Number one, I'll cover what is the golden rule of risk management. So we're actually going to start off with usually what I would consider as the end goal. I'm going to start you off by telling you exactly what the golden rule is. Then what we're going to do is we're going to work our way backwards from that, going through a little bit of math, learning about the difference between linear and exponential functions, why it's important to understand that in the context of trading, and talking about linear and versus exponential functions in the framework of a high watermark, and talking about blowing up your account. More importantly, how to prevent you from blowing up your account. And then one of the things that I want to cover is having consecutive losses, because with any type of trading, you are going to suffer at some point in your trading career a series of consecutive losses. And it's important to understand how those series of consecutive losses will affect your account and what are the probabilities of having those types of consecutive accounts. So looking at your portfolio from a holistic perspective, not just from a single trade, but from a large number of trades, and what you can expect to suffer and be able to recover from is really important. And then lastly, I'll show you some risk and money calculators that we've built that will allow you to apply the things that we're going to show you here today. So I'm going to start off by talking a little bit about the emotions of trading, right? Because We all suffer from it because we are natural. We are human beings. We suffer from this. So here's a trade setup. Here's a stock that recently was trading a little bit sideways and approached this support level. And maybe you thought that by approaching the support level, it was a good time to go long. You got an initial move to the upside, and then boom, the stock started to move lower. And I think this is a scenario that many of us may find ourselves in. This was the first trade was a perfectly valid entry point on that overall trade. But as you got into that trade and this trade started to go against you, what happens? There are two ways you can address this. You can, number one, say the support level that I originally anticipated that was going to hold is not holding, so let me get out of my trade, cut my losses, and move on to the next trade. But many times that doesn't actually happen, right? Because many times what I find, we get attached to trades and we get attached to the idea of winning, meaning we want to be, and it's not necessarily just winning, it's about being right. We don't like to be wrong on things. It's in our nature to not want to be wrong. So what do? Many times what we do is we find rationales behind what has happened and maybe try to justify another trade. So looking at this particular trade, I might say to myself, well, look, I was initially wrong on this support level, but I still see some support down here from over here. So maybe I'm going to get a bounce back higher here. So now you're thinking, well, at the very least, maybe I can get a bounce back to break even so I can get out of the trade without taking on a loss. Maybe I can get back at break even. And what happens next? The stock continues to plummet. Now, at this point, you'd say to yourself, well, I'm definitely wrong on that first trade. I was definitely wrong on the second trade. I should really cut my losses and get out. And sometimes we do that, but other times we don't, right? Other times we find more justifications to get into this trade again, because now we look at the chart and we say, wow, this stock is near all-time lows. The stochastics are really oversold here, as you can see. Really oversold. These are generally good buying opportunities. So the fact that the second the stock starts to make a little bit of a run up higher, maybe it's time to start buying again. As you see this few moves to the upside. Now you're thinking, oh, maybe I can buy a little bit more and at least get myself back to maybe down 10% instead of down 20%. Guess what happens? The stock continues to move lower. Now, if this is a scenario that you have found yourself in before or are familiar with or resonates with you at some point, please type 1 into the chat window. If in the history of your trading, you've ever found yourself in this type of scenario where you've justified a trade after a losing trade, hoping to either make your money back or at least get yourself back to break even or get yourself closer to where you originally got into the trade. And I see a lot of ones flying by on my screen. And that is okay, because this is something that we've all found ourselves likely to have done in the past. So what I really want to do is not necessarily say that this behavior is bad, because I'm pretty sure all of you understand that this is not the right behavior to utilize with trading. But more so, I want to talk about how can you position yourself so that you find yourself less likely wanting to take on these types of trades. Because what I tend to find is that our emotional attachment to trades and our emotional attachment to being right many times stems from the fact that we may have risked too much capital to begin with on that initial trade. Chances are that if we risked a relatively small amount on that initial trade, we might not be as emotionally attached to that trade, and we might be okay with just letting a small loser go. But many times when we over leverage ourselves, when we overextend ourselves on trades, that's when we find ourselves being in the hot seat of saying, oh my God, I have to do something to try to make my money back. So this is why we want to start off our talk today with what I consider is the golden rule of risk management. And the golden rule of risk management is really simple. It's never risking more than 1% to 2% of your entire portfolio per trade. That's it. It's not a complex rule. It's really simple, risking no more than 1% to 2% of your account per trade. Now, what does that come out to be? That means if you look at this table here, I have an account value on the left-hand side, You can find your roughly your account value. Now, when I talk about your account value, this is referring to your discretionary account. This is not accounting for your retirement account where you have maybe $500,000 tucked away into your IRA or 401k. This is your discretionary trading account that you're playing around with when you're trading options, your speculative trading account. So whatever that account value is, what you want to do is you want to find a corresponding 1 to 2% column, and that is where you want to stay between. So if, let's say you have a $50,000 discretionary trading account, you want to trade anywhere from $500 to $1,000 of total risk on an individual trade. Now, how many of you have stuck to this rule, and how many of you have exceeded this rule? Type in 1 if you feel that you generally stick to this rule, and type in 2 if you feel that you generally exceed these types of thresholds for your trades. So I do see a lot of 1s. Great. So for those of you that have answered 1s, I applaud you for that. For those of you that answered 2, I hope that this illuminates a little bit as to why this is the case, why you want to stick to these types of rules. So I see a pretty nice blend between 1s and 2s. It looks like 2s are out numbering 1s a little bit, meaning more of you tend to exceed that 1 to 2% rule. And I do understand many times if you're trading with a very small account, a $10,000 account or lower, it's difficult to trade just this type of size. Many times you might be looking at trades that even a single contract is $300, $400, $500, and it's difficult to trade, with a $200 limit when some contracts are $300, $400. But this is really where, if you do have a small account, you have to be very careful which options trades that you make. And that means that you can't trade certain stocks like Netflix or Tesla or Google because the premiums are just simply too high. So the goal here that we're going to discuss is to really help you control your portfolio by focusing on controlling losses. And the reason that I say we need to focus on controlling losses, while most of the time we're more concerned about potential reward, but the reward will always be there. However, if you don't manage your risk properly, then you won't have enough capital left in your account when you have some losses to even try to make some gains. So that's why it's so important that whenever you're trading, the most important thing to focus on is controlling your losses. And the reason I say this, and the reason I gave the first example of buying into a trade, and then when it goes against you, continuing to double down in that trade and try to get yourself back to break even, is because small losses tend to be easier to accept and let go of. When you're only risking 1 to 2% of your account, if a trade doesn't go if it doesn't go in your favor, many times it's easy to detach yourself from a trade that you only lost 1 to 2% on. However, if there was a trade that you lost 10% on, that's much more difficult to swallow and just accept that loss and move on to the next trade. That's when we find ourselves more emotionally attached to that trade. Again, if you find that resonates with you and your trading, please type 3 into the chat window, where when you trade larger amounts of money, you get more attached to that trade and you are less likely to be able to let that one go, even though you might know that that isn't the right thing to do, or that you're going to risk even more money potentially on that given trade. So I see a lot of 3s. Now, I don't want to see 3s. The fact that I see 3s means that you are exceeding the 1 to 2% of your account rule. And hopefully after this webinar, it helps illustrate a little bit as to why it's so important to stick to these types of rules, so that hopefully next time I don't see any 3s. So again, the goal here is to try to make sure that you have enough dry powder in your account to live another day. That is the whole reason that we're doing this, is so that you have enough dry powder in your account to survive another day and continue trading. That is the reason that we focus so heavily on managing risk, because that's the only way that you can do that, is by managing risk. So in order to truly understand why this 1 to 2% rule is so important, I'm going to just look at a very simple piece of math as far as the difference between a linear and exponential function. So the thing about that you have to understand is that the returns that you have in your account are compounding. So many of you may have learned that interest, that compounds in an account or interest that you earn in an account is compounding, and it's a very powerful effect. The difference is that exponential functions take a long time to come into play, but when they do, they really take off. And that's really the crux of the difference between a linear versus exponential function. A linear function is just a straight line. Exponential function takes on very slowly, but when you compound them, it grows very, very fast. Now, this works on both sides, both on the loss and the gain side. So when you have losses, they compound just like exponential gains. And the goal here is to try to minimize your risk so that you can actually so that you can maintain a portfolio to even have any upside on your trading. So what I'm going to do is I'm going to come back to linear and exponential functions, or I'm going to show you how they are applicable to your actual trading account. So first, we're going to talk about what you need to do to get yourself back to break even, because this is really where we are. This is the hole that we find ourselves in every single time we have a loss in our account. So what we want to do is we want to understand how much do you have to gain on a trade after a loss in order to get yourself back to break even. And the goal here is to try to minimize your portfolio drawdown, because as you can see here, when you have a 10% loss in your portfolio, it requires an 11% gain to get yourself back to break even. That's pretty close to, what you lose, you got to gain back to get yourself back to break even. But even at 20%, as you can see, it immediately magnifies. Instead of 22%, it's 25%. At 30%, you need a 43% gain to get yourself back to break even. At 40%, a 67% gain. At 50%, 100% gain. Now, as you can see, each one of these, the gains are incremental, but the further down you go, the larger they get. Now, pretty much anything beyond, in my opinion, this threshold right here around, I would say around 25%, anything to the right of this is extremely difficult to get yourself back from. Because once you're down 30%, a 43% return, meaning you have to be right so many times in a row just to get yourself back to break even, that it's almost impossible to do that. Because as soon as you try to get yourself back to break even, chances are you might find yourself at some point down 40%. And the amount of risk that you have to take to get yourself back up to 67%, chances are you're going to find yourself down 50%. It just becomes the slippery slope that becomes almost impossible to get yourself back from. So the goal here is that no matter what, you want to try to keep yourself on this side of this line. Now, how do you keep yourself on this side of the line? It's so that, because if you ever risk more than 5 to 10% of your account on a single trade, chances are you're going to find yourself on this side of the equation fairly often. Because if you're risking 5 to 10% of your account per trade, you only need 3 to 6 trades losing trades in a row to find yourself in that category. Once you find yourself in that category, it becomes, again, a very slippery slope where it's very likely that you will continue going down this path. And the further you go, the harder it is to ever get yourself back to break even. Now, I just want to make sure everyone understands this concept here. If that makes sense, please type 4 into your chat window. Okay, perfect. I see a lot of 4, so it sounds like everyone understands this. So again, the goal here is to try to stick to this side of the line, risking no more than 25% of your account, your portfolio, in order so that you have a fighting chance of getting yourself back to break even. So let's take this one step further. How do we prevent ourselves from risking 25% of our account per trade, or losing 25% of our account at any one point? So next, what I want to look at is how many trades it actually takes to draw down your account. So when you risk 10% of your account per trade, you need 10 trades to blow up your entire account. So 10% of your account, 10 trades, easy math, right? At 5%, you need 20 trades in order to blow up your entire account. But as you can see, for each 1% you go, each 1% less that you risk per trade, the growth at first is fairly marginal. There's not a lot more trades that you can do. But the further down you go, the growth of the number of trades that you can make before you blow up your account grows at an exponential pace. So each 1% reduction that you have in risk allows you to trade an exponentially larger number of trades before you blow up your account. Now, at 1% of your account per trade, you would literally have to have 100 losing trades in a row before you blow up your account. 2%, you need 50 losing trades in a row. That's a lot of losing trades in a row. Chances are, if you even have 10 losing trades in a row, you would probably think about whether or not you're trading the right strategy, whether you're following the right methodology. Maybe it's time to reverse the trades that you're doing or something along those lines of reevaluating your trading strategy. So the goal here is that when you're risking 5% of your account per trade, you're going to have 25% losses fairly often because it's not uncommon to have 5 losing trades in a row. And when you have 5 losing trades in a row, that is going to result in a 25% loss in your portfolio. So when we are below this 5% threshold, that is one of the best ways to really prevent yourself from risking less than 25% of your account. Being on this side of the equation, in my opinion, is one of the best ways to prevent yourself. Ideally, you want to be closer to this 2%, and that's why we choose this 2% rule. Because at 2%, you would have to have 12 or 13 losing trades in a row to blow up 25% of your portfolio. And in my case, in my perspective, that would be a pretty catastrophic loss, but you're still within the bounds of what's recoverable. But once you exceed that 25% barrier, that's when it becomes quite difficult to come back from. So again, before I move on, just want to make sure everyone understands this. Please type 5 into the chat window if this makes sense to you. Perfect. Okay, lots of 5s. Great. So let's move on to the next one. Next, now that we've talked about why it's so important, why the exponential functions are so important in helping you understand why it's so important to stick to 1 to 2%. Now let's take a look at what is the actual probability of you losing these types of trades. And this is really where we have to look at the probability of having consecutive losses. And this is a really important topic to look at because this is where we get into some of the math and the probabilities, but I don't want to scare anyone off. I want to help everyone better understand these statistics because it's really important to understand. So what I have here is a chart here, and the chart here tells you the win rate, meaning what is your current win rate with your current option trading strategy, and what is the probability of you suffering a certain number of consecutive losses. So as you can see, it goes from anywhere from 1 all the way to 10 consecutive losses in a row. So the reason I have the win rates ranging from 30 to 70% is because this is really the range that most option strategies will fall under. If you're always buying, out of the money calls, relatively low probability trades, you're going to find yourself in this category, in that 30%. Whoops, 1 second. You're going to find yourself in this camp, in that 30 to 40% winning rate. Keep in mind, 30 to 40% is not bad because that typically means that you have a very good risk-reward ratio on those types of trades. Vice versa, for those of you that are selling types of options, whether you're selling cover calls, cash-secured puts, or even credit spreads, you're more likely to find yourself in this type of camp, 60 to 70% winners. But again, 60 to 70% winners is more have negative risk-reward ratios, so your risk-reward ratio is not as good. And then most of you might find yourself somewhere in this middle range. I think most strategies will find themselves winning somewhere in the 40 to 60% range. It really depends on what type of strategy you're trading, whether you're predominantly buying strategies or selling strategies. So what we want to do is we want to explore what are your chances of actually having a certain number of consecutive losses per trade. So if you have a strategy that wins roughly 50% of the time, then you would have about a 1.5% chance of having 6 consecutive losses in a row. So let's do a little bit of math here. And the goal here, in my opinion, is you want to, for any type of strategy on average, is you want to account or plan for having at least 5 to 6 consecutive losses in a row at some point in your trading career. Meaning, think about December 2018. If you were selling puts going into that time, chances are you probably had, especially if you're selling multiple puts, chances are you had a large number of consecutive losses going into that month or ending in that month. And the goal here is to make sure that you keep the percentage, the total loss on your entire portfolio less than 25%. So if you're risking 2% of your account per trade and you have 5 consecutive losses in a row, what this means is that you have a 3.13% chance of having a 10% portfolio loss at a 50% win rate. So again, you have to evaluate what type of strategy you're trading, right? Are you buying out of the money calls? Are you selling naked calls and puts? Are you selling credit spreads? What is your average win rate? And that's how you can plan for what is your probability of having 5 to 6 consecutive losses. For those of you that are buying calls and puts, you have a fairly large probability chance of having 5 to 6 consecutive losses, anywhere from 11 to 16%. For those of you that are selling high probability, then you have a fairly low probability of actually having 5 to 6 consecutive losses. But it's important to understand what is the probability of that actually happening for your portfolio. Now, the thing about this chart is that that's very misleading, in my opinion, is that you can't just use 5 to 6 consecutive losses, because chances are we don't just place one trade at a time. Many of us, we place multiple trades at the same time. So what you also have to account for is the fact that you might have concentrated positions that are grouped together. What do I mean by that? If you have a bunch of long, let's say you sold a bunch of puts going into December 2019. Let's say you sold 5 puts on December 2019 on different types of stocks. Yes, you can think of that as 5 separate trades, but it's not actually 5 separate trades, because you have a concentrated position of all long stocks that are expiring on the same date. So you actually have to distribute your trades across expirations, perhaps even long, short, and different sectors to truly utilize this type of formula. If you do have concentrated stock positions or concentrated positions within a single long, short, or expiration, or within a sector, you do have to consider the fact that you have to group those together. So let's say that you're risking 2% of your account per trade, but you have 2 trades per expiration. So let's say you have 2 trades in December, 2 trades in January, 2 trades, 2 trades in December, 2 trades in January, and you're risking 2% of your account per trade. To have 5 consecutive losses, you actually have a 3% chance of having a 20% portfolio loss, because the 3% here is not reflective of 1 trade per expiration cycle, but actually 2 trades per expiration cycle. And I just want to show you, taking this example to an extreme, because some of us do have a lot of trades that expire on the same day, and it's not uncommon to have this, because if you do have 5 trades per expiration, now, even though you're risking 2% of your account per trade, to account for 5 consecutive losses in a row, you now have a 3% chance of losing 50% of your entire portfolio. And again, this is if you have 5 trades expiring on the same expiration that are maybe all long, then you have a substantially higher chance of having a much larger loss, or the same probability of having a much larger loss. And I just want to make sure everyone understands this, the concept of when you have a bunch of trades that are concentrated in the same expiration and maybe they're all long, that they don't actually account as separate trades. They actually have to be grouped as individual, as trades that are grouped together. So even though you're risking 2% of your account per trade, but if you have 5 of those trades on the same expiration and strike price, or maybe 5 trades on the same expiration and they're all long, then you're actually risking 10% of your account per trade and not really 2% of your account per trade. Does that make sense to everyone? If that does, please type 6 into the chat window. Now, if that was a little confusing for you, please type no, just so I can get a sense for if that confused anyone on that particular slide. Okay, so I see a couple of no's. So for those of you that answer no's, it's okay. this is not the easiest thing, in my opinion, to always understand. So I will try to. I have one more slide on this, so I'll try to clarify this. But what I'm trying to say here is that if you have 3 long calls that all expire on the same expiration date, then, and even though each one of them is risking 2%, what you're doing is that you're kind of just lying to yourself as to how much risk there truly is, because there's not just 2% of your account per trade. There's actually 6% of your account that's at risk because it's all expiring on the same day. And all it takes is the market to go down on that last week or so, and you have 3 losing trades in a row. So it's not actually a 12% chance of having that type of loss. There's actually a 50% chance of having that kind of loss. So I hope that clarifies a little, but again, I'm going to go on to the next one, and I hopefully will maybe clarify this a little bit more. So lastly, chances are, just like if you trade like myself, you don't just risk the entire account, you don't just risk the entire trade on a specific options trade. You might employ things like stop losses to cut your losses before, right? This is something we teach very heavily on our strategies, whether you're buying calls or puts, trading debit spreads, trading credit spreads. You generally want to have some place where you are going to cut your losses and reduce your risk. And this is something that can actually help you substantially if you do tend to find yourself trading a lot of trades on the same expiration date, because stop losses can help reduce the percentage of your trade that's actually risked. So if you have a stop loss of 50% on all your trades, and in my opinion, 50% is, in reality, even if you want a 50% stop loss, chances are you probably have closer to a 60% stop loss, because there's going to be some slippage. It's going to, not everything gets executed at exactly 50%. Things gap open, and sometimes you find yourself in a larger loss than your stop loss level. But let's say we're going to use 50% for math for now. So when we talk about having a 2% risk per trade, and we have 5 consecutive losses in a row, that this again refers to a 3.3% chance of having 10% portfolio loss. So again, 5 losing trades in a row at 50% is 3.3% chance of having a 10% portfolio loss. And 10% comes from risking 2%, 5 times, that's 10% of your portfolio. But if, let's say, you apply a stop loss, now what you have is the same chance of losing only 5% of your portfolio, because instead of risking 2% of your account, you're actually risking 1%, because you are cutting off that loss before it actually reaches the 2% loss. So you can account for the fact that you have a stop loss that will actually modify the amount that you're actually risking. So in the previous example, when I talked about having, even though you have multiple multiple trades per expiration, you can have a 3% chance of maybe a 25% loss if you had applied a 50% stop loss on that. So I hope that makes a little bit more sense for those of you that answered no on the previous one, that stop losses can also help you reduce your overall portfolio loss on these types of trades. It doesn't mean that you should increase your risk, right? It just means that you want to place your stops, and stops can help prevent some of that total loss and reduce the total amount that you are risking. If you use a 50% stop loss, usually you can, most of the time you'll get out maybe around 60% loss, given some slippage and given some transactional cost on that given trade. So I see a few different questions here. I'm going to come back to your questions. I'm going to answer them, but I just want to wrap up real quick and just, again, reiterate the dollar amount that you want to risk per trade should be based on the number of contracts, or the number of contracts you trade should be based on the dollar amount you're willing to risk. And the dollar amount you're willing to risk should, again, be used based on this type of chart. So what you can do is you can find your account value on this trade. So let's say you have a $50,000 portfolio. You want to risk 2% of your account per trade. A $50,000 portfolio means that the most you should risk on a single trade is $1,000. So if you're trading an option trade where you have $200 of risk per contract, that means you can trade a total of 5 contracts. So really simple math, right? You're really taking 50,000, multiplying it by 2%, that gives you $1,000. And what you're doing is you're dividing $1,000 by the risk per contract, and that will tell you how many contracts of that option you can trade. And I think it's, and I also want to reiterate, we're talking about the total risk per contract, not how much it costs you to purchase the contract. So when you're buying an option, yes, what you're paying for is the total amount of risk. But if you're selling options, you have to account for what's your max loss of that option selling strategy. So if you're selling a naked put, that can, you have to factor into how much you can lose on that naked put if the trade goes against you. If you're selling credit spreads, you also have to account for not the credit that you're receiving, but how much risk you're actually taking on that credit spread. And you always want to use that risk per contract to help you calculate how many contracts you can trade. So what I have prepared for all of you is a spreadsheet to allow you to actually utilize what I'm going to show you, what I've shown you here today. So you can click on this link here, and I'm going to show you what that looks like. You can, I just placed that link into the chat window for those of you that want to download this spreadsheet. It's a really simple spreadsheet. It includes the numbers that I showed you guys here today. You can download this directly from that link that I sent you. And when you open up, what it does is it very simply, number one, shows you the graphics that I use in my spreadsheet today. But more importantly, it allows you to enter your total account value. So let's say you have a $65,000 trading account. What it does is it calculates for you the number, the dollar amount you can risk per trade. And then what you can do is you can always plug in what is the maximum risk per contract of whatever option strategy you're trading. Okay, so if you're using options play, and I'll show you this in 1 second. If you're using options play, you can always click on the options play score and see what the max risk of a strategy is. So this doesn't matter whether you're trading the standard strategies we're showing you here, or you're constructing your own strategies like you're selling an iron condor. It'll tell you what your max risk of any strategy is, and what you can do is you can plug that in. So let's say I'm trying to trade this iron condor on Activision right now. It's telling me my max risk is $96. What I would do is I would plug this $96 into my spreadsheet, and it would tell me that I can sell 13 contracts of this iron condor. So you can plug in your portfolio value. Again, your portfolio value should be your discretionary portfolio, not your retirement account. It'll spit out how much you can risk per trade. You can plug in how much you're risking. It will tell you how many contracts you can trade. Now, chances are this number is not going to move a lot, day to day. Chances are this is something you might want to recalibrate once a month, or if you make a deposit or withdrawal from your account, you want to make sure that you change this every time you have a sizable move in your account value. So if you have a really good month and your account is up to 75,000, now you can trade 15 contracts for that same iron condor. But if you have a bad month and you get down to 55,000 or you withdraw some money, now it'll tell you could only trade 11 contracts. Really simple. And another way that you can also do this is on options play. Options play has a calculator already built in. So for those of you that don't have access to options play, you can use the spreadsheet. But if you do have access to options play, you can simply use the risk and investment calculator. You can plug in your $1,300 risk, and it will tell you to sell the 13 contracts that we originally showed you on the spreadsheet. So at 65,000, I can risk $1,300. I can plug that number into options play, 1,300, and it tells me that I can sell 13 contracts of this iron condor, which is exactly what this spreadsheet was telling me. So these two are in line. However you feel comfortable doing it. I certainly prefer using options play because it just does it for me. I don't have to plug in anything. I just have to know how much I'm willing to risk per trade, which again, you can utilize this spreadsheet to help you figure that out. Regardless of how much you have in your trading account, you just plug it in. It will tell you how much the risk per trade. You can also change it from 2% to 1% or 1.5%, whatever you're comfortable with. You can utilize this tool to change your settings, but I always tell users don't exceed the 2% rule and risk no more than that $3,000 on a trade. But then you can always plug that number in, and Options Play will calculate the 31 contracts here for you to trade this particular iron condor. So with that covers what I wanted to go over with you guys here today. I just want to remind everyone again, risk no more than 1 to 2% of your account per trade. Returns and losses compound exponentially. The great thing is that returns that compound exponentially, great. Losses that compound exponentially, that will blow up your account to the point where you no longer even have enough money to continue trading. And that is the end of the road. And you never want to get to the end of the road. And the only way to prevent that is to prevent the portfolio drawdown. And to do that, you can just simply follow the rule of risking no more than 1 to 2%. That's going to prevent your portfolio from drawing down too heavily to get to a point where it becomes impossible to recover. And one of the best ways, in my opinion, to do that, outside of sticking to that 1 to 2% rule, is to try to distribute your trades across expirations, across sectors, and across long short. So if you find yourself, even over the last couple of months, as the market has really just been marching straight up higher, it's still good to sprinkle in a couple of shorts along the way, especially when things get a little overbought. Sprinkle in a couple of shorts so that when you do get a short-term pullback, you have some trades that are offsetting some of the losses on your long positions. Take profit on some of those short positions when you do get a sell-off. And then when things continue moving higher, you continue with your long trades. So, if any of you that have followed our daily plays in the long run, that's how we trade. We don't just always take long only trades or short only trades. We always take a fair combination of longs and shorts. We do skew to more longs than shorts because that's where the market skews to. The market naturally moves up 60% of the time, moves down 40% of the time. So we're naturally going to have more longs and shorts, but it's important to have a combination of long shorts across the different sectors, across the different expirations. So I hope that you guys have been able to find this useful. Today, we actually don't have any real examples to go over with you, but the tools here is really just the Options Play tool, utilizing the risk and investment calculator, as well as the spreadsheet, which I just sent to everyone in into the chat window. So with that, what I'll do is I'll open this up for Q&A. And again, I just want to remind everyone, next week, I have a very special webinar with Tom Sosnoff from Tastyworks. I will send out an email prior to that webinar to allow you guys to submit questions beforehand. I'm going to have a bank of questions ready for Tom and I to discuss on the webinar next week. So I really look forward to your questions that you guys want Tom and I to answer. We'll be talking a little bit about the market, where we think the markets are going, and then we're going to spend some time answering your questions, and Tom's going to have an opportunity to show the Tastyworks platform for a little bit. So with that, I'll open this up for Q&A. If you have any questions, please type them into the chat window. I know there are a few questions already, and so I will take the time out to answer those questions first, but please type your questions into the Q&A, into the chat window, and I'll answer as many questions as I have time for. So Wayne says, I will review this recording. And I think Wayne was one of the users who said that they were a little confused by the consecutive losses, and that's totally okay. That's why we record this. That's why we make the slides available to you so that you can take this at your own pace. And again, for all of you that are learning how to trade options and taking the time out to sit through these webinars, I really applaud you because options trading is something that really takes most users a few weeks to a few months to even get comfortable with trading. It's not something you can just watch a single webinar and start trading options with. It's something that takes time to learn. And that's why we come back every single Thursday to teach you new concepts, teach you new strategies, and make sure that you understand best practices, and more importantly, show you what tools you can utilize to apply what we're teaching you. So I hope that you guys are able to take advantage of that and continue your education. So Anand is asking, if I have multiple underlying in the same expiration that are part of the same sector, then it is for all purposes a single trade? Yes, from a risk perspective, I would say that that counts as a single trade. So if let's say you have 3 long trades in the same sector and they all expire on the same day, that's like having a 6% risk on a single trade as opposed to 2% on 3 separate trades. You're really risking 6% on one trade. It's okay if you do that once in a while, but if you're doing that all the time, then you can see how you can easily exceed that 25% loss very, very quickly. So I hope that answered your question, Anand. Eric is saying, do you place stops in the market with options trades, including spreads ahead of time with the broker? Yes, absolutely. Yes, I place stops on my options trades, including spreads. Claude and Jurgen, yes, I'm really excited to have Tom on next week as well. William is asking, what do you think of CC? I'm guessing when you say CC, you're referring to a covered call. If you could clarify, William, I'm happy to answer that question. Casey is asking, how to blend this strategy for heavy stock portfolio? Good question. It's a little different with stocks, right? Because so what I would say is that it really depends on your, whether you're investing in the long term or if you're trading a stock portfolio, actively. Casey, if you want to, you can send me an email at info@optionsplay.com. We can discuss your specific strategy a little bit more before I, just before we talk about that. Mura is asking a great question. What are your stops for credit and debit spreads? So Mura, debit spreads are really simple. They're just like calls and puts, 50% stop loss. Credit spreads are a little bit more complicated because it depends on how much credit you're receiving with respect to the width of the vertical. So my suggestion to you is I have a whole webinar just on that. I recommend that you actually take a look at that webinar, which was, if you go to our YouTube channel, which I'm just sending everyone a link to our latest videos. So again, for those of you that want to learn more and you want to see all of our previously recorded webinars, we have 24 of our latest webinars on this playlist so that you can keep tabs on what are our latest educational events. And so I'm going to share this link with you, which is the link for the credit spreads, Mura. And I highly recommend you to take a look at that because I do talk a little bit more in depth in terms of stops for credit spreads. But for debit spreads, they're really straightforward. That's why I like trading them. 50% stop loss on debit spreads. Credit spreads, it really depends. Casey, thank you so much. Really appreciate it. Let's see. So William was asking, sorry, William, I don't know who that is. If you could... if you want to send me an email at info@optionsplay.com, I'm happy to look into that, but I'm not familiar with that person. Or if that's not a person, I'm not sure what that is, but happy to look it up and maybe comment on that once I've had a chance to take a look. Rick is asking a great question. How do you calculate risk on diagonal spreads? So from my perspective, you have to think about the diagonal spread has limited risk, right? So but you really want to think about diagonal spreads between now and the first expiration date. That's really how we think about the risk on that. Because, if you're trading a diagonal spread, the most you can risk is the difference between the two legs, or what you paid for what you paid for the difference between the two legs. So it really depends on your diagonal spread. I would say it depends on how far apart those two expirations are. It depends on how far apart the two strike prices are. So Rick, if you trade a lot of diagonal spreads, again, you can send me an email at info@optionsplay.com. Tell me a little bit more about your diagonal spread, and then we can discuss how you should calculate risk. But risk is really just the difference between the premiums that you paid versus the premium that you receive on that diagonal spread. Bill is saying, do you have a general recommendation on what percentage one should use for stops and the best type of stops? So I always just use the straight stop limit. I don't use trailing stops or percentages. As far as percentages, that really depends on what strategy you're trading. If you're buying calls and puts and debit spreads, again, easy, straightforward, 50% stop loss. Other strategies, it really depends. So you can shoot me an email with your strategy. I'm happy to take a look at that as well. Do you know any broker that'll accept stops on cover calls in retirement accounts? So I don't think the retirement account is the part that you are. I think brokers either support it or they don't. It really has nothing to do with whether you're in a retirement account or not. Michael, so are you suggesting that you want to buy back a call if it goes too far against you in a cover call? So the difference between a retirement account is the fact that you may not have enough capital to buy back that call. So that's a good question, Michael. I don't know for sure. I'd have to get back to you on that. I've been away and I'm very glad to be back for more of your excellent and very helpful webinar presentations and platform demonstrations, Tony. Thank you so much. Well, thank you for attending and telling me that as well. I'm really grateful for those of you that find this education useful, because that's really why we do this. And I'm really grateful for those of you that support Options Play and allowing us to continue our development of our platform and continue our education, helping you guys improve as traders. So with that, I just want to thank everyone for taking the time out here this afternoon. Eric, we did, but that has now expired. So Eric, if you want to shoot me an email at info@optionsplay.com, I'm happy to take a look at your account. Otherwise, thank you so much for taking the time out here this afternoon. I really look forward to seeing more of you here next Thursday, because again, we do have a very special guest. It's a very special opportunity for you guys to sit down and talk to Tom Sosnoff, ask him some questions, and get some really good insights from someone who is a veteran of this industry. You know, I learned how to trade options from Tom Sosnoff. I still use the Thinkorswim platform predominantly in my trading. So I'm very excited to have him on, and I hope you guys are as well. So thank you so much. Have a great evening, and I'll see you guys next Thursday.